thanks for joining us, and you're a dear friend of the EMTA.
Well, it's
and
my great
thanks for
pleasure.
everything you've done for us. We just heard your presentation, and I'd like to pick up on your book. That fascinated me, about your view of what's happening to our industry.
Yeah.
Yes.
Well, I love, Ralph, you're nice to ask about it. I love this business. I've done nothing else since I was 19. And so the first part of the book is really talking about just a lot of the experiences I've had, a lot of the characters we've all met, and the esprit de corps that people have. And then the other part of the book, though, really is a defense of the industry, because I feel I'm a little tired of going to cocktail parties or being on the sidelines of my kids' games and people talking to me about the Wolf of Wall Street.
Yes. Yes.
And how that's somehow related to
what we do. Never wanted to see
Yeah, I wouldn't recommend it.
Yes.
It has about as much to do with Wall Street as like knocking over a liquor store. I mean,
Yes.
it really, but somehow it's been conflated. And people don't understand, in my view, and this is what the book is really a lot about, ultimately, is that the capital markets are the reason why America is America.
That's right.
And the depth of the capital markets has been enormously helpful. Yeah.
We live in the capitalist system.
Yeah.
And you can't keep hitting the system. You gotta support the system.
It's amazing how even among educated people, though, that's a hard sell. It's become a hard sell.
Yes.
And so I'm hoping the book humanizes it.
Yeah.
Humanizes the business.
What's the
a little
title
bit.
of the book?
It's called My Side of the Street.
It's out already?
It'll be out in May by St. Martin's.
Good.
Yeah.
Wonderful. You talk about the long term, the market's long term. I call it secular.
Yeah.
When you say long term, how many years we going out?
Well, if you're talking a long term, like 10 years, the simple point I would make is that barring, it's probably going to have the type of multiple expansion that we've had since, let's say the early 80s and 90s. You started with 20% short rates and 15% long rates, very high taxes. Everything just got better.
Yes.
Now, of course, you're starting with 0% interest rates, 2% long-term interest rates, relatively low taxes. The one place where there could be easing that might be able to get some multiple expansions on the regulatory side. But aside from that, I think it's going to be hard. So longer term, to answer your question, I think you're going to have things that are more typical, returns that are much more typical with earnings growth, which is the long term of about 7%.
Yeah.
I do think dividends will be a bigger part of the total return. But I also think you're going to get a lot more volatility. And we have a technician, Chris Verone, who helps us out immensely. And I think as the markets get more volatile, he'll be more and more useful.
Yes, yes. Good, you got to have a technician on board.
Absolutely,
yes.
absolutely.
The industry has changed so much.
Yeah.
The buy side, sell side. You want to give it just your thoughts on that?
Yeah, I mean, I think there's too many people that are down on the business, which is sad to me. I think a lot of active managers are wondering whether their business is in secular decline. Again, I have a feeling that has a lot to do with the fact that we've fixed interest rates at zero for a long time, and I think active managers will add a lot more value than people think as interest rates start to be in more normal ranges. I think the sell side too is, it's evolving just to the extent to which in some ways, it's being disintermediated by private equity and some other ETFs and other things that are happening. So, but it's always evolving. That's the nature of our system. And there's still going to be plenty of opportunities for people in the business. It may not be quite as glamorous as it was in the heydays, but you'll have the true believers will stick around.
Yeah, good. I totally agree with that. And you talked about the volatility. And that's where active management is probably beginning to come back into vogue again.
Oh yeah.
Oh yes.
Oh yeah. I think the dispersion of returns, again, when you're fixing interest rates at zero, there's really no difference between a good company and a bad company, or certainly those differences are much narrower.
Yes.
Once you start rationing capital, it gets a little harder.
Yes.
And a good money manager, good technician will help you, go through that.
Well said.